Hey, what's up, guys? John here. Remember in 2020 when countries all around the world followed the same exact policy? They kept interest rates at damn near zero. They propped everything up. They printed a hell of a lot of money and gave an artificial sense of relief to, just about everybody. And so people thought they were geniuses because everyone was investing and everything was just going up, whether it be stocks, whether it be crypto, NFTs, residential, commercial, multifamily, real estate, industrial real estate. You just couldn't lose, right? Everybody thought that they were just an absolute genius. But now what's happening is that all of these very countries are doing the same exact thing together. They're all increasing interest rates and rug pulling billions of people into what I think is going to be the greatest wealth transfer of all time. And just reading what the IMF just put out is very revealing and very telling about what happens next. Also, today's video is sponsored by GreatCreditFast.com. That's GreatCreditFast.com. If you want to invest in what I believe is going to be the greatest wealth transfer ever, you're going to need good credit to be able to get a decent interest rate and get approved for a loan. Take a look at this. So, IMF blog, how falling home prices could strain financial markets as interest rates rise. Countries with elevated housing prices and high household debt issued at floating rates are particularly vulnerable to monetary policy tightening. The pandemic propelled housing prices to record levels in many countries, especially advanced economies, amid low interest rates and tight property supplies. Then prices started falling late last year in many countries, while others saw the pace of gains slow. The deterioration was more pronounced in advanced economies with signs of stretched valuations before and during the pandemic. With central banks raising interest rates to contain inflation, the average monthly rate reached 6.8% in advanced economies in late 2022, more than doubling from the start of last year. Now, if borrowing costs keep rising or remain elevated for longer, demand and prices are likely to weaken further. Now, pay attention to that sentence because look at what they just came out with. They said, and this was May 15th, Fed officials expect interest rates to remain high, possibly rise. So they said here that now if borrowing costs keep rising or remain elevated for longer, demand and prices are likely to weaken further. Well, obviously, right? Jerome Powell, Fed might hike interest rates again in June instead of skip, some economists think. No, it goes a lot deeper than that. So as a chart of the week shows, countries with high levels of household debt and a large share of borrowing issued at floating rates are exposed to higher mortgage payments resulting in defaults. Canada, Australia, Norway, Sweden are at greater risk according to data from Organization of Economic Cooperation and Development, a group of 38 mostly advanced economies. Now take a look at this. So UK home prices are expected to fall 10%, right? Canada, 56.9% of all mortgages are adjustable, right? That's a big number, a huge number. 20 to 40% increases in just their monthly payments because of these interest rate increases. So you start to look at this, right? If you were to get approved for a mortgage, let's say you're making easy math, you're making $8,000 a month, $100,000 a year, right? Which is a good income, making $8,000 a month, and you got approved for a mortgage of, we'll just call it $2,500 a month. So you're making this $2,500 a month payment, and then boom, now it goes from $2,500 a month to call it $3,200 a month. So you pay an extra $700 a month. But on top of that, insurance is going up and property taxes are going up. So maybe now you're paying an extra $1,000 a month. And so now you're paying $3,500 a month on $8,000 in income. But that $8,000 in income, you also have to pay income tax. You also have to pay for increased cost of everything, whether it be health insurance or car insurance or just basic food. Everything has been increasing the last couple of years. Before you know it, you're in a financial bind. And this is someone that's making $100,000 a year. Think about the teacher making $65,000 a year, right? And that's the average. The average is somewhere, between that $5,000 to $7,000 a month income, maybe even less than that. So when you start to see these big increases, what's ultimately going to happen? Banks are going to start taking massive, massive losses on a lot of these loans. A lot of these properties they thought had equity. The equity is going to start to go upside down as these interest rates and borrowing costs continue to rise. Banks are going to hold these losses and they're going to get tighter and tighter and tighter on their lending standards. And I think we're going to see more and more bank problems. So adjustable loans in America also hit the highest since the Great Financial Crisis, 2008. Right? So when we go back to this article, they show the areas in which they believe are most vulnerable. But if you look at a country like the United States, people are like, okay, it doesn't look too bad, right? Criteria 1, criteria 2, which criteria 1 is household outstanding debt as percentage of gross disposable income, right? So they're saying, people have money here compared to their debt levels. I don't know about that. I would actually challenge that. Share of debt outstanding at variable interest rates, they're also saying it's not that big of a deal. But criteria 3, share of households owning home with a mortgage. Well, of course, cumulative real estate prices growth, right? And cumulative policy rate change. All these things are going to be a big problem, a much bigger problem than what they're laying out in this diagram, or this chart. And the reason for this is I personally believe what we're going to start to see here is rapid inflation and increased interest rates probably for the next extended period of time. Let's just put it that way. Many people thought they were going to pull back on interest rate hikes in January this year. It doesn't look like that's going to happen. On the upside, in countries where housing prices grew rapidly, price declines in the run-up to the current monetary policy tightening cycle could improve affordability. Now look at how they say things versus what they're actually saying. They say on the upside, in countries where housing prices grew rapidly, price declines in the run-up to the current monetary tightening cycle could improve affordability. Well, if people are upside down on their properties, who can afford it? Nobody, right? Nobody's going to be able to afford it. So what's going to happen? Larger corporations, big banks, a lot of these, big institutions, they're going to swap these properties and be like, okay, well, we picked up these properties, now they can be affordable. No. Look at any type of business in which a monopoly is formed. Look at, for example, running ads on Facebook in 2011, 2012, 2013. It was super cheap. You can get in front of millions of people for pennies on the dollar. But now what's ultimately happening, they gathered market share, Facebook and Instagram, they gathered market share. They increased rates to a level in which it's very challenging for people to, afford to run ads on their platform, and especially for a small business. Same thing would apply with housing. If 1 or 2 or 5 or 10 big companies own more than half of the market, what's ultimately going to happen is you're going to start seeing prices continue to increase. And they say that, as we outlined in the World Economic Outlook published in April. Meanwhile, there are important differences between current conditions and global financial crisis a decade and a half ago. In most cases, while it is unlikely that falling home prices will spark a potential crisis, a sharp drop in home prices could dim the economic outlook, and the buildup of vulnerability warrants close monitoring in coming years and possibly even intervention by policymakers. Banks are better capitalized than before the global financial crisis, and underwriting standards in many advanced economies are tighter today than before the crisis. However, this is another misleading position as well, because they say that underwriting standards, let's say, for example, let's just say that they're right. Let's say that they underwrote loans are much cleaner today than they were in the past. One of the main challenges to that, though, is that if they're doing a debt-to-income ratio of, let's just say 30% or 35%, meaning if someone's making $9, then their payment will be $3, right? So if they're affording this, that's fine. But what happens if inflation is picking up at 10 or 15% a year? Some would challenge and say, if that is happening every single year, and insurance and everything else, the cost of actually owning and maintaining that property is continuing to rise, that 30% is going to 35 to 40% to 42%. It's going to continue to rise. And as we start to step into an environment where we're starting to see more and more layoffs, and we're going to start seeing more and more outsourcing, it could become a challenge to this statement that many of these loans were underwritten very clean. However, the average household debt-to-income ratio across countries is about the same as 2007, driven by households in economies that managed to escape the brunt of global financial crisis and have since run up since borrowing. Now, when we look at these mortgage rates, the 7% perfect credit, 7%. If you're slightly above the perfect credit score, which is a 698, by the way, you're still looking at 7.6%, almost 7.5. And if you're below if you're at the average credit score, which is below 700, 698, it's 8%, 8% for a 30-year fixed rate mortgage. Home foreclosures are rising nationwide. Florida, California, and Texas in the lead, and home listings fall. Now, I think there's going to be some really unique things happening in this housing market that we did not experience in the past. What this is going to look like if you have all these people that acquired mortgages between 2020 and 2022, 40% of all volume was done during that 2-year period. What are they going to do? They're going to start listing homes for rent, and we're going to start seeing rents crash. I've been warning about this for over a year, saying that rents are going to be coming down. I was the first one on YouTube to talk about how this is going to impact affordability, how this is going to change the entire landscape, and how a lot of builders are about to get wrecked. And a lot of investors that bought 3 caps and 4 caps are going to get smacked also. So it says U.S. rents fall for the first time in 3 years, April 14th. Right? Rents seem to be falling everywhere. Rents fall annually for the first time in 3 years. Why rent prices drop for the 3rd straight month? Apartment rents fall as a crash of new supply hits the market. Now, you think about this. All these people that bought second homes that they don't have any equity in their properties, what are they going to do? They're going to run it out. These retirees that thought that they had their retirement locked up and everything was going to be completely fine, what are they going to do? Are they going to sell their property for a lot less today than they could have sold for yesterday? No. They're going to probably rent out their homes. People that lost their job, they don't have any equity in their homes. What are they going to do? They're going to try to rent out their homes. You're going to start seeing so much new inventory hit the market. And as that is happening, you're going to start to look at all these other deals, all these other multifamily deals where their costs are continuing to rise and yet rents are, going to be softening and more, meaning that these operators are going to be in big, big trouble. So when we look at what happened globally in 2020 with monetary policy, you can see very, very clearly that this is going to be the economic rug pull of a lifetime. I actually covered this from a balcony in Mexico about 18 months ago, saying, why are all the smartest people in the world, all the execs, all the top CEOs, all the billionaires selling all of their stock? They're selling, not all, but they were selling, large blocks. For example, the CEO of Microsoft sold over 50% of his entire holdings at the height of the market. Why are all these people selling? And the reason for it, I believed, was because they knew that it's more likely that we're going to start to see valuations come down in a very dramatic fashion. Otherwise, they simply would just take a loan out against their stock, they'd hold their stock, and then they would, take the cash that they wanted. They could, borrow money against it, 1%, 2%, 2.5%. And then, if they really, really thought that, or if they really believed in their valuations, they would do that. But if stocks crash 50%, they get margin called, then they have to sell at a really bad time. So you look at it. Everybody was selling at the height of the market. Now we're starting to see this, and all these private equity funds, all these large companies sitting on mountains of cash, knowing that things are about to get rough. What do you think about it? Drop below, hit the like button, subscribe here, and add me on Instagram for short form content and other content I definitely not going to post here on @thisisjohnwilliams on IG. I'll respond to DMs over there as well. And if you want to fix your credit, go to greatcreditfast.com. That's greatcreditfast.com. Catch you guys in the next one.